This is part number 3 of our workshop on December 17th, and we went through a lot of the material that was maybe a little bit new to those of you who attended Advanced Like, of course. I think that material sets up the intention for us, which is extremely important to me, as to the contextual intention. What are we looking for when we're looking at our swing trade candidates? And we've talked about specifically when, in what structural spots of the market we're going to be going through the selection. Then we've talked about how would we define the market as a trend or as a consolidation, and what kind of trades are available to different type of traders in those different spots. Then we went through the second step, which was how do we go through the selection process? How do we scan? How do we filter? And as I was showing you the tools, we came to the conclusion that we need to also understand how the whole industry group is being traded in order for us to optimize our selection. So to understand this a little bit better, we're going to go through a case study, and we're going to study the airlines industry group, and specifically the run that they've had since 2009-2012 into the more recent highs. And specifically we'll look at Alaska Airlines, Southwest, JetBlue, and United. So here is the chart where we are starting our analysis, and we're going to be looking at the stocks at around 2012, and I've identified here on the charts not just the long-term structure for all of those stocks, but also a continuation of that move that they have had afterwards. And it's very purposeful. I just want you guys to see in the context of not just the selection and entry, but also what actually has happened. And these are the 4 stocks that were leadership stocks in different positions, and we want to explore where exactly after 2012 could we originate our swing trades, and in what type of stocks. And right away we could see that Alaska is definitely structurally outperforming all of the other stocks. Look at the sign of strength that we have had, backing up action to the long-term structure right here. So it seems like every other stock is somewhat close to that, but not necessarily there. We might argue that Southwest on the downslope has some kind of structure close to that, and yet we probably would be identifying a sign of strength in the backing up action slightly above that. And then for JetBlue, we're still in the trading range. And for the United, what's interesting is we had the original range here, and now we're having a reaccumulation. So that's probably a little bit more in line with the Alaska. But one of the things here, one of the key ideas is that a leading industry group will always have some kind of leader among the peers. And Alaska seems to be that leader. Since 2009, it has been going up, and it went up from $5 to about almost $20, somewhere in the 18 range. So that's about 3.5x. And it's a quite significant rise, and it shows that it's definitely leading the whole group. We could make an argument that United also had that leadership run, which I would completely agree with. And the only difference here is in the structure as to what comes afterwards. And it seems like the structure in Alaska is much more constructive. much more appropriate for any other further trades. So looking at where we are in 2012, this is where we want to start thinking about trading, swing trading, and not just the leadership stock, but also other stocks in that group. So how would we look at them, and how would we define them? Okay, well, the first analysis that we're going to do once we define the selection in terms of the outperformance, whether for the industry group or for specific stocks, we want to look at the structure, and we want to look at the volume confirmation, and also just confirm the whole outperformance picture again. So really quickly here, I'm not going to spend a lot of time on the structural analysis. You guys are well aware of that, and we'll do some of the key points on the structural analysis slightly later in the workshop. But here we're seeing how the decline is being stopped in phase A. We're seeing that supply is still available on the secondary test. It actually increases, so that suggests that not only we might have a somewhat of the weaker rally, but we also probably going to experience some kind of lower low here on the secondary test in the in phase B, and therefore if this is going to be a lower low, so most likely we either going to be looking at the down sloping structure right here, or the price is going to create a support cluster and phase C is going to come right here and retest it, which happens exactly in that way. The upthrust action right here could be sometimes confused as a sign of strength because there is some kind of commitment above the resistance line, but you have to look at the nature and the character of how the price moves to that point. This choppy move to the upside in the later part of the range, when the market in 2006 and 2007 is actually rallying, is not conducive to a sign of strength rally, the characteristics of it, and therefore we are most likely experiencing just an upthrust action. Also, another clue here that this is not a sign of strength was in this reaction right here, since the lows of the secondary test. On a sign of strength, the price, the best character of the price traveling to the upside would be without a lot of elements of supply, and we see how supply is coming in right here. So not necessarily the best sign of strength for us. All right, then as we go into the spring action, as we identified that it should happen below the support cluster here, we're definitely encouraged on the oversold condition where the stock is showing a lot of strength relative to the market. The downtrend has been broken. It also has a momentum tail right here, which on the rate of change is probably going to be even more extreme. So that shows us that there is a definite push to the upside that is going to be quite sustainable. And we're having a high low as a test of the spring right here. Quite a lot of supply on the way down, so therefore we have to have a test of that supply, which is a local test right here. And then after that, we could start initiating the positions. Point number one, point number two, right here, both of them. And then we are waiting for some kind of backing up action after the major sign of strength. The swing ends right here with this change of character. And that's what originates the trading range, and we are somewhere here in 2012. And this is exactly the time period where we want to start our analysis and where we want to go through all of the four stocks, and we want to pick the selection. And please remember that we're picking best of the best. We are going to a leading industry group, and then we are seeking the leadership within the leadership. And obviously, when I talk about the leadership, I don't necessarily only talk about the outperformance. You also have to look at the structural position. As I said, Alaska is the most advanced in the structure. Also, you have to look at the supply and demand as a confirmation of what kind of character of the move we're going to have after that. Southwest was an interesting picture because of this big shakeout after the original climactic action and secondary test. Please note how the price develops the structure into the phase B. We are having a lower high, lower high, lower high again, and relative to this lows, this is a lower low. So this picture suggests a structural weakness, and therefore we are expecting some kind of spring or shakeout situation going into phase C. Obviously, that what we see is more of the extreme of what has happened, but still you would be expecting some kind of lower prices in phase C just because of how phase B unfolded. We're also seeing that institutional participation increases, and we have a very strong rally. Yet this rally still does not necessarily outperform the whole downtrend that we've had here, defined by the relative strength. We're still in the downtrend of for our leadership here, and obviously not just among the peers, but also for the overall market. As the market goes up, we had a really good rally out of the oversold condition, and now we are making a higher low trading range, but the leadership is still down short-term and long-term. Now the question becomes is, if this group outperforms and has maybe already a long-term established leadership trend, the question becomes, do we actually come in and buy a laggard in this group, and at what point? So keep this question in mind. We're going to come back to this question, and we're going to address it from different angles. For now, let's come back to our slides and let's go to JetBlue. So JetBlue had a little bit more of the underperformance since 2008-2009 lows, and we're definitely seeing how the stock is still in the structure, in the original structure. Again, please note how phase B is being developed. A high here relative to the previous highs, higher lows, higher highs. What does that suggest for phase C? Well, we're definitely thinking that there is some kind of structural strength, so attempt to sprint is probably going to fail, and we're probably going to have LPS as a higher low, which happens exactly the same way. And then we are finally trying to lower the volatility, and we are very close to breaking the leadership trend right here. So is this a good place to open a position, swing position? Is this a good candidate relative to what we've seen before in Southwest and in Alaska Airlines? So keep answering those questions in your mind. And then as we go to the United, as I said, we had an extreme oversold condition. Usually out of those conditions, the price is going to rally very rapidly to the upside and then consolidate at the higher ground. And we kind of seen that. We're still in a downtrend here, but because of the prior leadership, we could assume that there's going to be some kind of continuation to the upside in this stock. And then again, I mean, looking at all of these stocks, and we're seeing all of the great indications for us that one way or another, we're going to somehow manage to travel to the upside. But that's not our intention. Our intention is more about picking up specific stocks that we will that will outperform not just the market but the group as well. So What would we do here on the swing term basis? Now we're looking at the same area, 2012, and we are going into more of the micro-analysis here of the comparative outperformance. And because all of the stocks in 2012 in this group has had some kind of consolidation, we're going to apply our very simplistic comparative analysis. So how would we do this? Well, here's all these 4 stocks, and we want to find the leadership based on the comparative outperformance. Comparing all of the stocks here, we're seeing that Alaska Airlines is definitely outperforming by not only making higher highs, higher lows. The stride with which the price makes those higher highs, higher lows is actually much better than in other stocks. We're seeing how all of them are having a positive stride, and that would be also reflected on the relative strength line if you're using that. But we're definitely seeing that Alaska is outperforming. What else is very interesting here? When you look at the comparative outperformance, you want to compare different points here, not just an overall stride of the slope, but also, like for instance, in Southwest, I'm seeing a lot of, I'm seeing a lot of lows that are going below the stride of the lows between the September and October lows here, and obviously those are different years even. So the fact that Alaska is not doing that is actually showing a lot of strength and potential outperformance. Another thing that is catching my eye right away is the September-October period right here. Alaska is already traveling to the upside, whereas other stocks are not progressing to the upside as much. So again, because Alaska was a leader and it's in the major sign of strength, and then this whole thing is just a backing up action trading range. We are seeing more interest from institutions for this stock rather than for its peers. But of course, the idea of kind of like spreading their position bets throughout the whole industry group that outperforms is going to take place at some point. And we're going to see some moves in the stocks that were underperforming, and those stocks gonna start outperforming because those buying waves in those stocks are gonna produce that momentum that we've talked about. So at this point of time, we're still most likely attracted to the leadership here in terms of the potential outperformance, and we're seeking some stocks, some other candidates that might potentially outperform in the future, and those are going to be the ones that we would be looking for, to buy as a change in as a rotational swing trade idea. There was a question that came to me during the break in the email, and the person was asking, what about the leadership stocks? How could we buy them if they're going to start traveling much faster than the overall market, or much faster than just an industry group? And what you are doing with this is you are defining the prior leadership first. So here is our prior leadership. And you're saying that this stock, if it goes into the reaccumulation range, is going to probably resume the uptrend. Most likely, if the uptrend is going to be in place, it's going to resume the leadership, at least for now, and momentum is going to start coming in. So the entry into this position still going to be based on your first market timing and synchronicity with the market. Let's just, for the sake of it, let's just go and see where we are. So this is September, July, September, November of 2012 for Alaska. Okay, and I'm gonna put here the market, and let's put it, hold on a second, where is it? Not below, okay, yeah, below. Okay, let's see if it's gonna give it to us. Yeah, okay, yeah, I think that's sufficient. So here's the stock, here's the market, and let's go to 2012. Let's identify that period. Okay, so here's this consolidation right here. And we're seeing that for the market, we've had two significant moves to the downside, which would identify really good swing opportunities for long-term swing traders. The previous opportunity of the same sort would be somewhere here in this area. So we basically, for the long-term swing traders, we want to catch this type of swings. And we want to start looking for areas of outperformance in the stocks that are leadership stocks, right, in the leading groups. And one of them is Alaska Airlines. So this major sign of strength comes right here. There is a big decline, so we kind of have to structurize this whole price movement. We go up, and then we have another structure right here. So based on this structure, you can enter somewhere in this area right here, just because of how the market making lower low right here, and the stock is making higher low. So we have a outperformance, and it seems like structurally we might be in the potential phase C with the potential major sign of strength and the backing up action right here. And then as the stock starts to outperform in this area and the market starts to underperform, we're going to be heavily attracted to this stock because it shows that the institutions are actually readily coming in and buying, supporting the stock when the market is going down. So this would be the timing. And in a lot of cases, leadership stocks are going to start behaving this way. So the key is to start scanning during the reaction. Start scanning during the reaction, during the reaction, during the reaction, and keep coming up with the leadership candidates through all of this action. And if you are scanning in this area, this stock should be on your radar right away. This is the stock that is going against the market. Instead of going down, it's actually going up. So it's definitely a great place to open the position. Now imagine that the stock market is going to reverse at some point. And usually when you're looking at those reactions, you're probably thinking, okay, well, if this is going to be the same magnitude reaction, I'm going to expect a specific X number of percent on the decline. So I can even anticipate where the reversal will happen, and if it does happen, you know, I want to be even more aggressive. And as the market goes down, you're seeing the stock is being counter trending, you know, this reaction. So that should attract your attention right away. Leadership sometimes is gonna, you know, start traveling much faster, much earlier. than the market overall, and than other stocks. So therefore, you know, we we're going to be attracted to this stock in this spot. Also, please note, as the market goes down, what other stocks are doing here in August, September, October. Southwest is not going down, but it's just consolidating. JetBlue is trying to go up a little bit, and then United is also trying to go up a little bit. So all of those stocks are exhibiting the characteristics of the leadership stocks, even though three of them are not necessarily the leader, you know, within the group. So we're still attracted to Alaska Airlines, and therefore we would be establishing a swing position somewhere here in this area as the market goes down and the stock is going up. So let's see what kind of performance we had based on our analysis. And here I'm using the exits for the underperforming pairs that is going to be synchronized with the exit of the Alaska Airlines, because that was the trade. So here on the change of character, we're saying that around the first days of April, we will be exiting this position. So this is a long-term swing trade, and it produced 71% in absolute returns. When we look at other stocks, look at their returns: 39, 57, 30, and again, I'm using kind of like the same synchronized exit, and you could see how all of the stocks in the same group are exhibiting the changes of character or some kind of reaction when Alaska is showing a change of character right there. Now, why is this important? Well, we started our workshop with an idea of optimization, with an idea of the most efficient swing trading. And here's this idea as we, you know, looking at this returns in absolute terms. Even if we take on average, let's say 39, 30, 57, we're probably averaging around what, maybe like 40% on those three stocks against 71%. So we are gaining on Alaska about 30% over the average performance in the group that is a leading group, you know, for all of those stocks. Think about it for a second. Over 30% in the profit that we have on our position. If you have, let's say, between 15 to maybe 25 trades a year as swing trades, and let's say that half of them are winners and half of them are losers, and that half that are winning stocks are all overperforming by 30% on average any other swing trading positions that could have been winners for you. What kind of effect that's going to have for your yearly performance? Obviously, you're going to outperform, and obviously you're going to perform in a very significant way. Now, think about this. If you have a specific number of years left to invest for whatever reason, you know, maybe you're going to retire, maybe you know, there is a specific deadline that you have in your mind that you're going to be trading these stocks for, and then you're just going to stop. So let's say that maybe for the next 10 years you're going to be extremely active with your swing trading. Imagine such outperformance, which is basically almost, you're making almost as much as twice more profits, slightly less than on any other selection right here. if you're consistently producing that type of outperformance for the next 10 years, your P&L and equity rise is going to be quite different than the one where you're picking up other candidates. You're still profiting, but you're not profiting as much. So this whole idea of optimization of our trading comes to analysis as well. It comes to the idea that we have to understand which stock, even within the leading stocks, is going to outperform in a more meaningful way. All right, so here is one example. Here is a second example. Same stocks. We're going into the next stepping stone. And then I see the remark there from one of you, and it says, that's important at my age. Okay? And I usually a little bit more doom and gloom because we know how our lives are going to end, right? We're all going to be gone. But what we do between now and when we are gone is that's what's important. So this whole idea is about that. It's about how much time we have left in all of our cases and how are we using it even in investment and trading. So that's why picking up those best candidates based on those small ideas that are so nuanced ideas is extremely important. Let's look at the next selection in 2013. Next stepping stone. Kind of like the same very simplistic technique where we're saying, okay, I want to be in the leading group and I want to pick up a leader out of the leaders. So let me look at the April lows and September lows and see which one to pick. Now I'm seeing that Alaska, the stock which has been a leader for quite some time, and we bought it long term, might be, back into the teens, at teens, maybe a slightly less, or we just had this last swing trade that was great, that gave us plus 31%. It's actually underperforming Southwest. Southwest is having the same formation, but this formation has higher lows. It also seems that this second rally is outperforming in its own way. It actually goes and exceeds the high that was a climactic high right here. And we don't necessarily see this from other stocks. Look at Alaska. The climactic action right here on this rally is not being touched, and therefore this is a much weaker rally. So what does it tell us? That tells us that there is still interest in this stock by institutions, but maybe they already have such a significant position, they are looking for the value proposition among other stocks in the same leading group. And maybe Southwest is one of them, and because of that they are buying more of this stock, and as they buy, that's going to produce the rally that's going to outperform other rallies in other stocks. Same here, we're failing, and not necessarily the same picture with the United. We're having actually a good rally right here. Oh, I'm sorry. Here is September. What am I talking about? Hold on a second. So let's negate this. So actually, yes, we have a really, really good rally right here. But what's happening here with United is that we are definitely going below the low of April here and making a slightly lower low. The fact that here we have a quite substantial decline suggests some supply, which comes here, and we know when supply is increasing, we need to do some kind of testing. So in this testing should come on higher low, and it should come on the contraction of the supply, which we do see further down the road. This is our higher low, and this is a contracted supply. But other stocks are already traveling after September low. So even though it seems like there is some interest here, but we are definitely seeing some selling going into phase C. So therefore, Southwest was a natural pick for us among the leaders. And we are expecting that Southwest is going to outperform all other stocks. And again, I'm using here for the exit only the exit in the stock that is outperforming and that supposedly we purchased, we opened the position. And look at this outperformance. At the point of exit, we are having 100% return on this trade, and that's from September to about late June. So quite a big trade, and you can even divest this trade into smaller portions, like this swing right here, this swing right here, this swing right here, this swing right here, and then even compare those swings to other swings in other stocks. Like we would be comparing, let's say, this swing in October, December of 2013 to this swing right here. And this is their original swing, so we still would be in this stock. We're looking at the reaction right here. We would be comparing it with this reaction. We're still going to be in Southwest. And you kind of can manage the trade like that as well. Again, more shallow reaction, much deeper supply reaction. So again, we want to stay in Southwest. And maybe only here we might be inclined to change this just based on a slightly lower low, but we might as well just stay until the end of this trade. It still seems like a much better trade than anything that we've seen before. And I don't necessarily see any other smaller swing trades here that might potentially outperform. At the end of 2014, we're still having a much more favorable structure in Southwest. So even if we missed this momentum trade, we're still given a really good percentage rate here. So think about this again. We definitely want to be in the stock that's going to be outperforming. The idea of being in the stock that just going to produce us a positive alpha, which they all do, is almost like a relic idea. It's so old. It's so not innovative in trading. If you want to be efficient, you have to think about the best possible swing trade that you can find and you can trade. Also think about this. Let's say that we are doing diversification idea. And diversification idea is actually kind of the idea that I don't like necessarily. I think that diversification idea should be only applied, to situations where you have a lot under the management, the money, and you have some kind of risk parameters that you are responsible for to implement in front of your clients. So for instance, big hedge funds, big insurance companies, big pension funds, funds by the city, by the state, by the government, and all this stuff, this type of investors that are big, or the type of investors that have to comply with their risk aversion strategies. So then the idea of diversification there is quite appropriate. In our case, when we are trading for speculative purposes, when our intention is to create wealth through speculation, and swing trading is basically speculation, then the idea of diversification would not work for us as an efficient idea. Even with this, think about that. If we have a limited number of money that we could invest into a specific theme, into a specific idea, not a specific stock. So I'm saying, like, I see the leadership in the airline stocks. I'm going to diversify among four peers here for outperformance and buy all four of them: Alaska, JetBlue, Southwest, United. What's going to be my return if I'm going to divest like that? So basically, there's going to be a lot of weight on the three stocks that are going to underperform relative to Southwest, and then Southwest is the only one where we're going to have a outstanding outperformance. So therefore, if your goal with trading and investment is a high growth speculation, then you definitely have to pay attention to this type of approach, where you are selecting among the leaders based on the idea that the leader is going to outperform the peers and not just the market. And there is a remark right here. Okay, then we would rotate out of Alaska at some point and move into Southwest. Absolutely, and that's the idea. Because we're swing traders, the idea of the rotation between these two stocks, and I'm going to show you a big picture here, so we would see it on a kind of like a big big picture here. We said that our first favorable trade was in Alaska, and this was the swing that we took, and that was the swing that has outperformed all of them. But then Southwest right here identified to us an opportunity of outperformance into the future, and we have taken this whole move to the upside. Please note how Alaska was moving. There is a definite levels of supply that we are experiencing on the way up in Alaska, and that just shows that some money are not coming in anymore as the money or the supply that was absorbed in Southwest. And that's the idea of the rotation between our swing trades in the same leading group among the leadership, right? So let's look at JetBlue. We had a big reaction right here. So that would be somewhat of a difficult spot for us to trade. Let's look at United. All of these reactions in 2014 as Southwest is going up so drastically, and you're looking at Southwest, and if you have a position in the United and you're going through this consolidation, or you're out of the trade, you would be biting your nails for not being in the Southwest. So again, I'm stressing out this idea because it's extremely important idea to me personally, as to how I approach this, and I want you to see the value in this idea and to think about your swing trading from the perspective of efficiency and optimization, and from the perspective of how many years do you have left for your investing, and what are you going to do with that? Are you going to just like routinely open the positions in the stocks that you kind of saw somewhere on the news? Maybe you went through some kind of scanning parameters and you kind of like saw, oh, I see the structure here and I'm going to invest. Or are you going to be more detailed? Are you going to be a much deeper thinker about this? And are you going to pick up the ones that are potentially going to be outperforming in a much more significant way? So I challenge you to do that. Question: should we perform comparative analysis between these four stocks on a daily basis? There is no really need to do that on a daily basis, because all of the structures, as you could see here, let's take the last example right here, and please kind of like keep in mind the structure of the market here in 2013. Actually, we didn't look at the market structure in 2012 right here. We were looking at the market that was having a low in 2012, So we were going down like this. Then a high going into the next rally, and then the low going into the rally into the Alaska. So that was the market structure. So therefore, where do you perform such comparative analysis? You start performing it during the reaction. And you can do this on the daily basis here. I want you to be extremely active in this spot because that's going to create an awareness, as to the overall market structure. It also will increase your awareness as to what are you looking at, what are you selecting, right? But you can also do this analysis probably on a weekly basis, like on Friday, Saturday, Sunday. I don't think that it's going to, take away from your analysis or you're going to miss some kind of entry points. You're still going to put the stock on the watch list, and then you can look at this on the daily basis, for your points of entry. Also, another idea here is that you could start thinking about, synchronicity with the market and look for the reversal in the marketplace and then just synchronize that with the entry. It could be a little bit late, but still you might find the points of entry right here. So I guess if you have enough time on your hands and you're devoting, a lot of time to your trading, you could do this on a daily basis. If you have a 9-to-5 job, my advice would be not to overwhelm yourself with this daily analysis of all of the stocks that you have. If you are a short-term swing trader and you're looking for swings like this, something like that, then you might have to do that on a daily basis. And obviously you're going to have many more trades, and in some instances your rotation from one stock to another is going to happen much more often. You might have some outperformance in one stock where you're not necessarily going to have it even in the leading stock. So for smaller short-term swing trading, you might have to do this. But primarily, I would say for a larger time frame, you just want to pick the leadership, find the point of entry, and just stick until the end of the trade, and then find another outperformance like we see here. All right. So let's go also through, strength and weakness analysis here from a different perspective. One of the things, and we're coming back to the monster beverages here, one of the things of the ideas, and I already talked about this for so long, so I'm going to spend just a couple of minutes here. We want to identify institutional sponsorship. And that usually is going to come with an idea that there is some kind of prior outperformance, which is being reflected also on the relative strength line right here. And I'm just showing you this as an example of how you can see that prior outperformance. And then once we go into potential reaccumulation, the idea is that we're going to resume the trend. We're going to resume at some point the outperformance. This stock is going to become a leader again. And out of the downtrend in leadership by the relative strength ratio line, we are looking for this. We are looking for the point where the stock is starting to outperform. And obviously we want to synchronize that with the potential point of entry right here, which is being shown to us by the market. So based on our time frame, let's say that we are long-term swing traders, we want to find the market opportunity here, market entry, and we want to find the beginning of the outperformance, the return of the prior outperformance of the prior leadership, and we just basically want to enter it if the structure allows and if supply and demand allows. So let's look at this a little bit closer. One of the ways that we could identify that as I've said before, as I've shown you before, is through analysis of the group and peers with the heat map. By the way, for those of you who are not using our heat map, and because you're all students in this class, please use this. Here is the password on Wyckoff Analytics. Go to tools and then pick the heat map, and Wyckoff123 is going to be the password. So use it. And I would say that you can use it both for historical purposes and also for most current data. So we're seeing how the group here is rotationally starting to perform much better. From 104, it goes to 44. We want to look at the leadership, and we're seeing that at the top half, Monster Beverages is also showing that rotation from 65 to 29. That's a good jump in this number of weeks, and obviously that comes with the gap right here, probably the earnings, and we just want to see where the stock is going to give us some kind of point of entry. If we were thinking that this was a potential phase C, this is definitely acting as a reversal bar, so there is a potential point of entry even before the gap happens. Because the gap brings a lot of supply with this, it is being shown as a climactic action, and all of the subsequent tests after that show us that there's going to be some kind of consolidation. There's going to be some change of character, supply coming in, and it needs to be absorbed on the next potential test. All right, so let's look at Monster Beverages from the same perspective as we look at the Alaska and Southwest and their outperformance, and let's find the kind of like the reasons of why we could potentially open this position. And sometimes it has to come from a different perspective. Sometimes it has to come from the perspective of where we are in the structure. So looking at the stock in 2014 here, we are seeing that there was a prior outperformance. It was really significant outperformance relative to everything that we've seen before in with other stocks. And let me just make sure that we are on the same time scale right here. It's interesting how it looks slightly different. Okay, so 8/8/14, yes. So look at what Monster Beverages is doing, right? So there is a lot of outperformance, whereas Coca-Cola is just basically consolidating. There is some consolidation in Dr. Pepper for the same period of time until 7/15. So I've been right here, right here, and then right here somewhere. So relative to all peers, we definitely seen some kind of outperformance. So this is the prior leadership. And then we're seeing a very big decline. What other stocks are doing during this decline? So some consolidating, some already going up, slightly going up. So we would be looking for some kind of rotation in our swing trading in this group, because it obviously shows us some of the leadership, and we're seeing how Dr. Pepper also exhibits some leadership prior to that. So probably in this area right here, going into May, this could be one of our candidates, for this swing trade. So this would be a really good trade. In terms of the rotation, where is it, 5/16, right? So 5/16. We do have a swing trade right here, but it's still structurally not at the best place. Look at where we are with the structure. We are slightly out of potential phase C right here, or maybe even less so. Maybe this is A, maybe this is B, and this could be C for us. We still don't know. We need to see some kind of sign of strength here. But at this place for Dr. Pepper, we are in the stepping stone after the prior moves to the upside, so we're assuming a reaccumulation. So therefore, any type of phase C, we would want to buy, and we would want to hold it, through the whole trade. Here, if we're gonna go further up, there's all-out performance in this area right here, so a more appropriate swing trade before a potential move to the upside right here is happening. Now, the same, by the way, the same in a way right here, right? Let me just synchronize this a little bit. Yeah, 530, and then 523, 523. Yeah, I thought that there was something, like a smaller data set right here. So we're basically looking into this area right here, and into this area. So we're seeing a sign of strength in the backing up action, which is actually even much, much better than Dr. Pepper. So for this swing trade right here, Pepsi was much, much better. I mean, look at the velocity and look at the beautiful trade right here. You are not going to stress out about this trade at all. It's just going to be on your radar, and almost each day you're going to have up movement. So also think about, in terms of when we are talking about optimization and efficiency of swing trading, think about in terms of how the price moves, in what way, and how is that going to influence your trade. So obviously, we would rather be in this swing trade right here than the one that's going to have some kind of reactions, right? So it goes into like, let's say between 516 and 59, 516 and 59, so right here. So this is not even that trade. So even though we might be thinking, okay, well, this is a backing up action right here as well, and I'm having trouble synchronizing all of this. Hold on a second, where is this? So this reaction right here is between 530 and 523. A little bit hard to see. So I think this is it right here. Yeah, I think that's it. Yeah, we would be talking about this decline before considering both of them. So there is much less volatility right here in Pepsi than in Dr. Pepper. So you kind of seen what I'm doing here, right? What I'm doing is I'm trying to pick up the market timing for our entries. I'm trying to pick up the leading groups where significant moves are going to be experienced. And among the industry groups, among the industry peers, I'm trying to pick up the spots where either structurally or in terms of the outperformance, we're going to have specific stocks that are going to do much better, and therefore if we're going to swing trade them, we definitely want to swing trade the stocks that are going to have those type of characteristics. Okay, so looking at this picture here, on the right, we are not necessarily being satisfied with this position for Dr. Pepper. Again, we have traveled so much, and this is where usually that question comes: how could I trade this stock? And usually that comes from students because their confidence level in the uptrend increases, and that's in line with the risk aversion of some of the traders that we have, and therefore they're going to tend to express this confidence at the much later stages of the rally or a trend. And basically we are not having anything left here, maybe a slight move to the upside and then a consolidation. In a way, kind of like the same with Pepsi, there might be a smaller range here in the continuation. That's a possibility. The same with Coca-Cola. We might have some range and then a continuation. But we're definitely being underperforming after so much of the strength And at this point of time, think about how institutions are thinking. If they are looking at all of these 4 charts and they have to pick one stock, which one would they pick? At this point of time? They're probably going to go for a stock that is going to be assumed undervalued with previous characteristics of leadership. So they're going to be thinking that this stock is undervalued relative to all of the moves that we've seen in other stocks, and yet it was a previous leader. Would they buy that? Yeah, absolutely. They would want to buy this type of stock, and we want to catch this next buying opportunity, to the upside. And obviously, here it is. Hold on a second. Let me again, I'm just trying to synchronize the charts a little bit in my head. Okay. One of the questions here, and let's just, before I go to this slide, let's just address one of the questions. Do you mean to say strength prior to phase C on Monster's weekly chart? Prior to phase C. Well, we definitely have a lot of strength right here. So I don't see necessarily any outperformance relative to the peers here, maybe a little bit on this rally right here. So when we're talking about an outperformance, you can think about outperformance in 2 categories. You can think about a stock outperforming the market or all other stocks. And you can also think about the outperformance of the stock relative to its peers, right? So when we are talking about outperformance, I think this one, right? This one. So prior to phase C, outperformance right here. Well, we are not necessarily have to have the outperformance prior to phase C in the structure, right? Remember, we were talking about that prior leadership is much more important for the reaccumulation than the performance, outperformance in the structure itself. Why? Because this is the time when the stock is being under some profit taken, which is temporary, yet the majority of the supply that came on the hold on a second. The majority of the supply is still in the strong hands, so it's not being provided to the market. So therefore, we might have an underperformance during the reaccumulation, and I'm trying to find here. I'm just kind of being confused here with this question. Strength prior to phase C. Where is that? This chart? This one right here, in the uptrend after significant reaccumulation, stepping stone trading range in the backing up action, perfect position. Okay, I think that we should go away from this question. I don't see what is meant here. Okay, well anyways, so maybe during the Q&A we could come back. I just don't see it where it's just saying that. Okay, so the key here is to understand that we could have area of the underperformance, but the question here is supply still under the control of big institutions, of CO types of institutions, and did we have, and after the prior leadership, and if it's not being provided to the market, then most likely we're going to assume that this is going to be a reaccumulation, only with the potential signs of the distribution that we might be starting to think that phase C is not a really good place for us. So therefore, phase C is an appropriate place for us, even in the underperforming range, to at least establish a small position and see how that's going to unfold. So here is our first point of entry, and then on the next market, on the next rally and on the next reaction, we basically continue on our comparative analysis and asking the same question: is the rally or the reaction stronger than the market? And in both cases, we definitely see that there is strength on both. So here is the market and here is the stock. Again, we would be looking for those market opportunities to establish the position. So here is the range for the stock, potential phase C. Look at the market. So it gives us that opportunity to say that here in this area, I would be looking for some swing trades. Why is it in this area we cannot buy the stock? Well, because structurally it's still not there. It's still phase A or phase B. And even though the market gives us an opportunity to buy on all of these reactions where volatility is going to go down naturally on all of these reactions, and this is going to be a swing trade, this is not the stock that we want to swing trade during this period. There are tons of other stocks that are going to outperform, that are going to show us a much, much better outperformance and potential future leadership. But here, this is appropriate. We are seeing that volatility has increased, giving us a change of character for the market, and then a potential phase C here with a slight increase in the volatility. We can use this point of entry for our swing rate here. So here is this entry. And then going into the rally and the reaction, both answers to the question is yes, the stock is stronger than the market. So therefore, we could select this stock for the continuation of this trade. And please note how much more stronger the stock is. As the market goes down and you're going to start your selection process, putting different stocks on your watch list, this stock is going to go on the watch list, maybe somewhere in this area right here. You're going to start seeing how the market goes down and the stock actually goes up. But now it's not necessarily the time to buy the stock just because of how much supply came on this buying climax and how much supply comes on the change of character, which suggests basically a consolidation and some retest that comes later on. But as this retest comes, it's a higher low for the market that declined about minus 10% in October of 2014, and the stock is basically flat. So that suggests that the institutions are not selling the stock with the market. This is the stock that where supply is still firmly being held in the hands of institutions. So therefore, a really good candidate for us for a swing trade, and we call this a sweet spot. So unlikely you're going to find this in any of the literature. This is a Romanism. I just come up with this myself. This sweet spot signifies the area where we want to see a sequence of outperformance on the rally and on the subsequent reaction during the times when market is showing a reaction in the up market. And we want to find this type of scenarios in this sequence when the market is going down. So those stocks are going to significantly outperform. If that's an earnings gap, and that's a question, should we consider that as a difficult trade to take? After a gap, we'll take a backup after the gap with the backup. So which trade, this one or this one? Because obviously there is no questions about this trade, right? This is very understandable. We are having a lot of outperformance. Structurally, it all complies with our Wyckoff structure. But this trade, Yeah, so a couple of thoughts here. Again, I kind of went through the structural analysis, so it seems like this was a phase C. It seems like an appropriate time during the market, and there is a reversal right here. Now, if this is an earnings, and it comes here, and one of the things that, and we've discussed this during different classes, one of the ideas here is, what do you think institutions are doing before the earnings? Are they acting like you are acting? Are they also thinking this is the earnings, so we are not going to buy, or we're not going to, or we're going to sell, or we're going to go away out of the position? Unlikely they are thinking the same way. They've established a position a long time ago. For them, this is not a swing trade that they need. They are basically already in the position and they're controlling the supply. If they're seeing a higher valuation for the stock, and let's imagine that the earnings have a negative surprise for the market for this particular stock, and the stock jumps lower, and has some kind of gap, let's say 10, 20% down. If institutions are seeing this, seeing some, valuation much higher, let's say at 150 or even $200 for this stock, do you think that they are gonna buy or sell on that gap down? Most likely they will buy more, because that presents an opportunity for them to load up even more, and their average price is going to go lower if they have a very strong conviction that it's going to go up. So that's one idea. The second idea about earnings is that most likely institutions are going to be buying the stocks at the time prior to when the earnings are going to start improving. The whole reasoning for them to buy a stock is because they see that the stock price is going to improve in the future. And their time horizon is just too much far away from what we trade. They're thinking in terms of the business cycles. They're thinking a year, 2, 3, 4, 5, 8 years. And this is the type of the trend that they want to participate in. So why would they participate in that trade? Just because they see some kind of improvements that are coming in for this particular stock in the nearest future and then in the long-term future. So what would those changes do to the earnings? What do you think? Would those earnings be primarily negative or positive? I would say that in total, out of all of the earnings that are going to be in the uptrend announced, we're probably going to have less surprises on the negative side, more surprises on the positive side, and just plainly more positive earnings outcomes. So therefore, we are seeing the trend developing, and it's being confirmed by the fundamental data like earnings. Therefore, in the uptrends of the leadership stocks, when we are talking about a potential earnings outcome, there is a much lower probability of the surprise to the downside rather than surprise to the upside. There is a much lower probability of the negative earnings over the positive earnings. And therefore, also kind of like think about who would be selling on the gap down. If institutions are seeing higher prices for the stock, would they be selling to that gap? Unlikely, right? They're going to be looking at this as an opportunity to buy more. So therefore, who is selling there? Well, probably some institutions that are still going to create a sizable movement in the stock, especially overnight actions. The ones that are showing maybe like short-term picture deterioration, exactly, or some weak holders, among institutions, some what we call them weak professional hands, right? So we have strong professional hands and we have weak professional hands. Institutional managers also could be wrong. Their time horizon could be a little bit smaller than just, those CO types. So I would say that I think it's a misconception, and it's a huge misconception, actually. Let me state it like that. Among retail traders um, to either close the position before the earnings or not participate in the earnings announcement in the stock that is in the leading group and among the previous leaders or among current leaders. Yes, you are going to have some instances where the stock's going to gap against you. But in the majority of cases, if you're correct in your Wyckoff analysis, meaning that you're correct in the thinking as to how institutions are participating in the stock, most likely you're going to benefit from it rather than, have some kind of negative P&L. And I like this comment too. So here's the comment from a student. I guess it's just fear. Yes, it's just fear of uncertainty because we don't know before the announcement exactly what the announcement will be. And it's very natural for us to fly away and not to think this through in a more logical way. So again, my challenge to you here is first, understand the narrative behind the earnings from the institutional point of view, and I don't mean from like short-term institutional trading, but more of the long-term trading. Understand where negative surprise is going to take place, most likely in some reaccumulation ranges where some short-term underperformance by the company cash flow is produced, and then they expect one number for the earnings, and actually that's a different number. So it's kind of like a misconception by the management. What they're doing basically is they, in a way, confusing the market, and that could produce a short-term negative surprise on the earnings. But everything else should be in line with how big institutions are thinking about the stock. So I would do just a little bit more research, and just even recently I was looking at Goldman Sachs, and I put all of the earnings on the chart, and I was looking at the estimate, and I was looking at the actual number. And the majority of the time, the companies are going to try to produce any type of outperformance, even by a cent, right? So you kind of have to understand the sentiment also as to what the analysts expect and what actually happens and how the price reacts to that. But you're going to build the whole system based on earnings reports as to the direction of the price. And maybe I should actually include this, in some of the classes for us, because this question keeps coming up and coming up and coming up. So good question, good discussion, and yeah, let's do a little bit more research on that. Does chart kind of demonstrate what kind of earnings we might expect? That's an interesting question too, related again to the same concept. And I would say that I think that there might be a little bit more of the confusion right before the earnings as to how the earnings are going to play out. So I think that the short-term picture is not necessarily going to be showing you exactly what's going to happen with the earnings. In a lot of cases, I see the last bar before the earnings being a very bearish bar, and the supply is increasing drastically. And that's just a reflection of an overall volume increase and overall participation by different market traders the participation increases. They are making the bets right before the earnings. And the bearish negative day, unless it's a huge bearish negative day, but the more kind of like subdued on the higher volume signature bearish day before the earnings is not necessarily bearish. A lot of participants, again, based on the idea of the fear before the earnings, based on the idea of uncertainty, are just going to step down, is going to step away. Other participants are going to actively hedge. Other participants are going to actively buy before the earnings because they want that directional risk and they want that directional profit, you know, if they are right on the earnings. So my idea here is more about a long-term picture and where the earnings actually happen. Are they happening in the structure? Are they happening, let's say, in the established uptrend? So for instance, right here, if we're thinking that this is a reaccumulation and we're seeing some kind of underperformance by the stock, I would be less inclined out of the structure to put on the position for the earnings report rather than, let's say, if we would have the same situation somewhere here, because here we've already experienced a sign of strength in the backing up action. So if the earnings are going to happen, it's probably already discounted by big institutions that this move as a gap is going to happen in the future. So you just have to pick your spots with earnings where you know, you're going to be more confident trading earnings and where you will be less confident trading earnings. And by the way, there is nothing wrong in just staying away where you feel like, you know, the structure was weaker and we only have a structural place, you know, to open the position. And you might just go away and you're just gonna say, just show me a confirmation. And once the confirmation comes, then you can trade the earnings after that with more confidence. Okay, very fascinating and interesting topic. So let's definitely come back to that, you know, at some point, you know, in our studies. Structural analysis. So we definitely want to look for a structure anywhere for any of the stocks. We want to understand where institutions are participating. So coming back to Monster Beverages, we're looking at the latest range right here. We're seeing that the major moves always happen after some kind of structure. So we're expecting that the move is going to happen here as well as a continuation of the leadership. So let's look at the trading range right here. Well, one of the things that we've discussed already is the points of entry. So here's our first point of entry, here is our second point of entry. And again, you know, the question here on the structure, where are we in this structure? Are we in phase C before the points of entry? Are we in phase D already? And obviously we were looking only at this range right here and we were discussing this gap. So this was the earnings gap right here. So you kind of already see that even from the structural point of view, you're having higher highs, higher lows. So structurally, quite a strong range for us to have here. And therefore, if you're anticipating the earnings here, you might be thinking, okay, in the stronger range, if institutions are basically buying and absorbing the supply and then holding the supply is going lower here, so they are not presenting actively supply to the market, then what kind of earnings could we possibly have? So I know it's a very speculative idea, but you know, we are speculators at the root of our trading, so you kind of have to sometimes, you know, go through this logic and take a bet and be okay with the bet even if it doesn't work. So let's go through the analysis, and I'm gonna leave you here with some of the slides which are definite repeat of the slides from everything that you've seen from me before. For those of you who are new to my material, you can, after the workshop, read more attentively, you know, through the descriptions of the accumulation, distribution, trading ranges, what each phase means, what's the intention behind the phases, and what kind of structural Wyckoff points we are going to have during the trading range. Do that on your own. I'm just going to give you these slides as a reference point. And obviously, you know, a slide like this just to go through all of the definitions right here as to each of the Wyckoff points right there. So we are looking for identification of phase C, all of the possible accumulation ranges. And by the way, I'm going to add, to some of the schematics here probably for the next cycle. Distribution the same way. So again, just keep it for your points of references. So we are thinking first in terms of the conventional Wyckoff labeling. And conventional Wyckoff labeling are going to define the climactic action and automatic rally and define the boundaries of the resistance and the support based on these two points. And we see that the price is actually deviating not around those boundaries. So right away you might be thinking that something is wrong with conventional labeling, but yet if we would be thinking about the conventional labeling this way, we might be thinking that there is one test, second test, third test, potential phase C, sign of strength, backing up action, and then a continuation in phase E. So this is quite appropriate. And even with this conventional thinking, we're still making a profitable trade. Even if we're not entering at this point, we might be entering at this point right here, which is either phase D right here or phase E. With, and there is a comment here, looks like a reverse TP formation. Yes, there is some elements of the TP formation here that you might see, but also, I probably would be thinking that for the TP formation, we would want to have a little bit more aggressive rally first to the upside. That's going to negate the majority of the gains to the downside that we've had, and then attempts to go down, down, down in this type of apex formation with all of these failures to reach the high. So the only difference, and I think it's a great observation, the only difference that I would say for the TP, reverse TP, would be that this first rally is going to be more substantial and it's going to define the urgency of the composite operator to come in and to absorb all of the supply as soon as possible. An alternative Wyckoff labeling, because we're seeing higher highs, higher lows, stronger trading range, we might assume that we are in the upsloping structure. And with the upsloping structure, it's very kind of like difficult to be correct about this. So sometimes students send me an upsloping structure, and sometimes I say, no, it doesn't make sense. Why? Because it's already an uptrend. And in a way, this is an uptrend right here. But there are some principles that are at work here that we could identify as principles behind the labeling, Wyckoff labeling. So what are those? Well, the first one is the sign of strength. We're seeing how the sign of strength and the backing up action after that are actually in lines with the principles of Wyckoff labeling. The sign of strength we would prefer to see on the increase in demand and on the increase in spread and daily gap action provided us with this weekly spread. And then the backing up action, we want to have a very reduced supply levels and reduced volatility. We were going through this, right? So volatility increase into the change of character, decrease, 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 even more decreasing. So whenever we have even more decrease of the volatility, what should we expect here? What kind of move? Not only to the upside. This is not interesting to us anymore. We already know that it's going to go up. The biggest interesting question is how. How is going to go there? In what way? In what manner? Is it going to be a move that's going to have a very small supply and therefore our trade is going to have high velocity, incredible outstanding P&L in terms of the overextension compared maybe to the peers in the same leading group? And how easy it's going to be traded by us on the way up. So this type of question we're going to address, and I keep saying this, in the Wyckoff Practicum course, which, by the way, you can guys start registering for January. I already put up the page. I send you an email. For those of you who have not received an email, let me know. Just go to our website, go to the calendar. I believe January 3rd is going to be the first session for the Wyckoff Practicum, so don't miss that. It's this type of questions that we're going to address, and it's this type of much deeper thinking about how the price actually moves we're going to address in that class. So with the alternative labeling, again, we're starting with the climactic action and automatic rally. Because of this slope information, our support and resistance are going to have the slope to the upside. We're still looking for the 3 areas of tests, 1, 2, and then 3. We're looking for a second point of fear, which here is not necessarily that big. I mean, compared to this reaction, it has less volatility. But think about this. If the second point of fear does not occur going into phase C in the way how we would expect it, and it has less of the volatility, or quote unquote, quote, less fear behind this move, what kind of move we're going to have here? Probably much, much better than in a stock that has this type of, volatility increase. Okay, so that would be our alternative labeling. And obviously, all of these changes of character as an idea, we are seeing how the rally is starting to outperform any of the rallies that we've seen in the trading range, how reaction is so shallow, much better than any of the reactions in the trading range. So that defines for us a change of character, and that defines for us a change in the volatility and the timing of the stock being ready to move out of the range. Okay, so a very quick structural labeling on the daily. So I've talked about this phase C, sign of strength, and then the range by itself. Because of this availability of supply that comes in, we are thinking that this is a change of character, and therefore we're going to have some kind of trading range for a backing up action. So therefore we are not going into the stock right away, although there is quite a lot of thinking about this spot right here, where we are defining this as a potential lower low for the whole trading range. And I'm quite all right with this idea in general, in terms of identifying this particular low in the change of character as the lowest low in this range. And actually, Wyckoff described this type of trade when he talked about the leadership of the stock in the bull market, and the first reaction having some kind of profit taken after a big move up. And usually he would say that this is going to be the lowest point in the trading range potentially, and you can buy either that particular low or some kind of test of that low. Now, again, I'm going to repeat, as an idea, I'm quite all right with this. But as a trader, I actually have some hesitation about this idea. Because if I'm comparing two potential points of entry, let's say one based on the idea that this is going to be the lowest low here, and then the second point of entry based on the retest of the supply that comes in this area, then I'm much more efficient trader out of this spot than out of this spot. Why? Well, because even if the price goes up slightly for your point of entry, you're still spending almost 2 months in a stock that is basically consolidating. So it's highly inefficient to use the money where it doesn't work. Think of the money, think of your dollars or whatever currency you use in the world, and we have quite a few international students today. Think about your money as soldiers that are going to become generals once the trend is underway. So soldiers are coming in, let's say at this point of entry, and then as the trend develops, they become generals because their valuation grows up. So I'm committing my soldiers at this point, I'm committing my money at this point, and what do I get in the return for 2 months or 4 months and a half? Nothing. Only emotional worries in this trading range. I might be okay, because I'm seeing that all of the attempts to go down aren't successful, but I'm also not moving anywhere with this position. So therefore, this entry, even though it could provide a much better absolute entry in terms of the actual price where you're entering, so maybe somewhere here at around 90 rather than 95, but then you kind of thinking, are there any other opportunities that I'm missing? So here I'm making $5 in 1.5 months, or what would it be? $5 on the $90 stock, so that probably is going to be around, what, 7% in a month and a half, which is a great number. But what if another stock, let's say the same price stock, let's say a $90 stock, has moved out of this spot more? Maybe it moved so quickly in a month and a half, and maybe it produced 30% return. What is better? Obviously, stock number 2 for us is much better. So therefore, I'm not actually inviting you, to adopt any specific strategy about this, but I want you to be extremely aware about the possibilities and opportunities around those ideas. So I'm trying to voice all of them. I'm trying to give you my perspective, perspective more analytical and then more from the trading perspective. And then you guys decide what you're going to do. All right, so let's see what else do we have. Okay, great. So what we're going to do is we're going to stop here. This is going to be our last break, and it's going to be for 10 minutes, and then after that we're going to come back. Let's come back again sharp at 3 o'clock. I'm going to log off. We're going to relog in. I'm going to log in right away, and then we're going to start with our volume analysis. All right, guys, I'll see you in 5 minutes about.